Imagine waking up tomorrow and discovering that every insurance company on Earth has quietly stopped covering fire damage. Not because fires disappeared, but because they've become mathematically impossible to predict. You'd panic, right? You'd realize something fundamental has broken in the system. Well, that's exactly what's happening right now in the world of sovereign debt. The so-called safest investment in the world, government bonds, is becoming uninsurable. Not slowly, not theoretically, right now, silently, and almost nobody's talking about it. For decades, investors treated government bonds like financial bedrock. The logic was simple. Governments can print money, raise taxes, seize assets. They don't go bankrupt like companies. They restructure, sure, but they survive. And because they survive, you can insure against their default. You can buy credit default swaps, sovereign risk insurance, political risk coverage. There was always someone willing to bet that the government would pay you back. But that era is ending. The insurance market for sovereign debt is quietly seizing up. Premiums are spiking. Coverage is vanishing. And in some cases, insurers are walking away entirely. Why? Because 6 silent triggers have converged to make sovereign risk not just dangerous, but incalculable. And when risk becomes incalculable, it becomes uninsurable. This isn't a story about one country. This is global. This is structural. And this is accelerating. By the time this video ends, you'll understand why the next wave of sovereign defaults won't just hurt bondholders. It'll shatter the entire insurance architecture built around government debt. It'll freeze capital markets. It'll trigger bank failures. It'll force governments into emergency controls you haven't seen since World War II. And it's already begun. So let me ask you this. If the safest asset in the world is becoming too risky to insure, what does that say about everything else you own? If that question made you uncomfortable, hit subscribe. Because we're about to go deep into the machinery of the global debt system. And what we find there is going to change how you see every government, every bond, every promise of stability you've ever been sold. Let's start with the first silent trigger. Hidden off-balance sheet liabilities. You think you know how much debt your government owes? You don't. Not even close. Official debt numbers, the ones splashed across headlines, the ones politicians argue about, those are just the tip of the iceberg. Governments have become masters at hiding liabilities. They don't call it debt. They call it contingent obligations, implicit guarantees, future commitments. But it's all the same thing, money they're going to have to pay, but haven't admitted yet. Take pension obligations. In most countries, government pension promises aren't counted as debt. But they're real. And they're massive. The US alone has unfunded pension liabilities estimated at over $70 trillion. That's not national debt. That's separate. That's off the books. Japan. Similar story. Europe. Even worse in some places. These aren't fringe numbers from conspiracy blogs. These are actuarial estimates from central banks and finance ministries themselves. But they're buried in footnotes. They don't show up in debt-to-GDP ratios. So when you see a country with manageable debt of 60 or 80% of GDP, you're missing the real picture. Add in pensions, healthcare commitments, infrastructure guarantees, state-owned enterprise bailouts, and suddenly that 60% becomes 200%. Or more. Now here's why this matters for insurance. When an insurer prices sovereign risk, they rely on official debt figures. They model default probability based on debt servicing costs, revenue projections, historical patterns. But if half the debt is hidden, the model is garbage. It's like insuring a house for fire damage without knowing there's a gas leak in the basement. You think you're covering a modest risk. In reality, you're sitting on a bomb. And insurers are starting to figure this out. They're realizing that the data they've been using for decades is fundamentally incomplete. So they're either jacking up premiums to absurd levels, or they're walking away entirely. Because you can't price what you can't see. And it gets worse. Because governments have an incentive to keep hiding liabilities. Why? Because the moment they admit the true size of their obligations, bond markets panic. Interest rates spike. Borrowing costs explode. The debt spiral accelerates. So they keep the illusions alive as long as possible. They kick the can. They use accounting tricks. They reclassify liabilities. They push costs into the future. And insurers, even the smart ones, can't keep up. Because the game is rigged. The disclosure rules are written by the same governments that benefit from opacity. So the insurance market is flying blind. And when you fly blind, you crash. Let's move to the second silent trigger. Foreign exchange mismatches. This one's technical, but it's lethal. Here's the setup. Most developing countries borrow in foreign currency. Dollars, euros, yen. Why? Because international investors don't trust local currencies. They want to be paid in something stable. So governments issue dollar-denominated bonds. Seems fine, until it isn't. Because those governments earn revenue in their own currency. Taxes, fees, tariffs, it all comes in local money. But the debt? That's in dollars. So if the local currency weakens, the debt burden explodes. Let's say you're a country that borrowed $1 billion when your currency was 10-to-1 against the dollar. You figured you'd pay it back with 10 billion units of local currency. But then a crisis hits. Your currency crashes to 20-to-1. Suddenly, that same debt costs you 20 billion local units. You didn't borrow more. The dollar debt didn't change. But your ability to pay just got cut in half. And this isn't hypothetical. This happens constantly. Argentina, Turkey, Lebanon, Sri Lanka, Zambia, they've all been crushed by FX mismatches. And it's accelerating. Why? Because the dollar has been strengthening. US interest rates have been rising. And every time the dollar goes up, every emerging market with dollar debt gets squeezed a little tighter. Now, here's the insurance problem. Traditionally, you could model FX risk. You'd look at currency volatility, central bank reserves, trade balances. You'd estimate the probability of a big devaluation and price it in. But the world's changed. Currency movements have become wildly unpredictable. Why? Because they're driven by factors that have nothing to do with the borrowing country. A surprise Fed rate hike. A geopolitical shock. A sudden flight to safety. These are external, uncontrollable, and increasingly frequent. So even if a government manages its budget perfectly, even if it runs surpluses and controls inflation, it can still get destroyed by currency moves it didn't cause. And insurers can't price that. It's not about the country's fundamentals anymore. It's about global capital flows, which are chaotic. So insurers are getting hammered. They're paying out on defaults that their models said were unlikely. And they're realizing the models are broken. Because currency risk isn't isolated anymore. It's systemic. Which brings us to the third silent trigger. Derivative exposures. This is where it gets truly scary. Most people think government debt is simple. The government issues a bond. An investor buys it. The government pays interest and principal. Clean. Linear. But that's not how it works anymore. Modern sovereign debt is tangled up in a massive web of derivatives. Credit default swaps. Interest rate swaps. Currency swaps. Collateralized debt obligations. Structured notes. These instruments are supposed to spread risk. Instead, they concentrate it. They create hidden leverage. They link countries that have no business being linked. And they make the whole system fragile. Here's an example. Let's say a European bank holds bonds from an African government. To hedge the risk, the bank buys a credit default swap from a US insurance company. Now, if that African government defaults, the US insurer has to pay the European bank. Sounds reasonable. But now add complexity. That same US insurer sold CDS contracts on 50 other countries. And they're all interconnected through the same financial institutions. So if one country defaults, it triggers payouts that strain the insurer. If 2 default, the strain becomes severe. If 5 default at once, the insurer goes under. And when the insurer collapses, the banks holding those CDS contracts lose their hedge. So they panic. They dump bonds, which causes more defaults, which triggers more CDS payouts, and the whole thing spirals. This isn't theory. This is exactly what happened in 2008 with mortgage-backed securities. AIG sold credit default swaps on subprime mortgages. When the mortgages defaulted, AIG couldn't pay. The company collapsed, and the entire financial system nearly went down with it. Only a government bailout stopped it. But here's the terrifying part. The same structure exists in sovereign debt. The same interconnected derivative web. The same hidden leverage. The same concentration of risk in a handful of institutions. And this time, the entities at risk aren't private companies. They're governments. Which means there's no higher authority to bail them out. The lender of last resort is the borrower. It's circular. It's unstable. And insurers know it. They've seen this movie before. So they're quietly backing away. They're refusing to sell CDS contracts on certain countries. They're capping exposures. They're demanding collateral that borrowers can't provide. Because they understand that the derivative web has turned sovereign debt from a calculable risk into a chaos system. And you can't insure chaos. Now we hit the fourth silent trigger. Political interference. Governments don't just borrow money. They manipulate the rules around that money. They pressure credit rating agencies. They change bankruptcy laws. They interfere with creditor rights. And they do it all in the name of national interest. But from an insurer's perspective, this is catastrophic. Because it means the rules of the game can change mid-play. Let me give you a concrete example. A few years ago, Argentina restructured its debt. Bondholders were told to accept a massive haircut, sometimes 70 cents on the dollar. Many refused. They wanted to be paid in full, as the original contract promised. So they sued in U.S. courts. And they won. The courts ruled that Argentina had to pay. But Argentina refused. It passed laws making it illegal to pay holdout creditors. It accused the investors of being vultures. It rallied public opinion against them. Eventually, after years of legal warfare, a settlement was reached. But the damage was done. Investors learned that contracts don't matter if the government decides they don't. And insurers learned that legal protections are worthless if courts can't enforce them. This pattern is repeating everywhere. Lebanon defaulted and then just stopped negotiating with creditors for years. Zambia defaulted and blamed it on the pandemic, even though the debt was unsustainable long before. Ecuador, Ukraine, Pakistan, they're all restructuring under terms that treat creditors as optional. And in every case, there's political pressure to shaft the bondholders. Because voters don't care about foreign investors. They care about jobs, pensions, public services. So politicians have every incentive to default first and negotiate later. And insurers have no defense. They can't price political risk when the politics are irrational. They can't model a government that will break contracts to win an election. So they stop insuring. They pull back. And the market for sovereign risk coverage shrinks. But here's the deeper problem. Political interference isn't random. It's correlated. When one country defaults and gets away with it, others watch. They learn. They copy. If Argentina can stiff creditors and survive, why can't we? So defaults cluster. They happen in waves. And each wave makes the next one more likely. Because the stigma fades. The consequences lessen. The insurance market weakens. And the whole system becomes more brittle. This is a doom loop. And it's accelerating. Fifth silent trigger. State-owned enterprise debt. Governments don't just borrow directly. They borrow through state-owned companies. National oil companies. Development banks. Infrastructure funds. Power utilities. And here's the trick. That debt often doesn't show up as sovereign debt. It's classified as corporate debt. But everyone knows it's really government debt. Because if the state-owned company defaults, the government will bail it out. It has to. National pride. Political stability. Economic function. So the debt is implicitly guaranteed, even if it's not officially counted. China is the master of this. Officially, China's government debt is only about 50 to 60% of GDP. Sounds manageable, right? But add in the debt of local government financing vehicles, state-owned enterprises, and policy banks, and the real number is closer to 300%. Maybe more. Nobody knows for sure, because the data is opaque. But insurers know it's enormous. And they know that if a major SOE defaults, Beijing will step in. Which means that corporate debt is really sovereign debt in disguise. And that blows up every risk model. Because insurers priced that debt as corporate risk, higher yield, higher risk, diversified across sectors. They didn't price it as sovereign risk, lower yield, concentrated, backed by government guarantees. So they're undercharging for the exposure. And when the defaults come, they'll be shocked by how correlated everything is. A property developer defaults in China. The local government financing vehicle that lent to it defaults. The provincial government bails out the vehicle. The central government bails out the province. Suddenly, a corporate default has become a sovereign crisis. And the insurer, who thought they were holding diversified corporate bonds, realizes they're actually holding concentrated sovereign risk. They get wiped out. And the market learns that SOE debt is a trap. This isn't just China. It's everywhere. India, Brazil, Indonesia, Saudi Arabia, they all have massive SOE sectors. They all have hidden guarantees. They all have debt that's mislabeled. And insurers are starting to wake up. They're demanding higher premiums. They're requiring explicit guarantees. Or they're refusing to insure SOE debt altogether. Because the game is rigged. And they're tired of losing. Sixth and final silent trigger. Credit rating model blind spots. Credit rating agencies, Moody's, S&P, Fitch, they're supposed to tell you how risky a bond is. AAA is safe. BBB is okay. CCC is dangerous. Simple, right? Except the models are broken. They're backward-looking. They're slow to react. And they're compromised by conflicts of interest. Because rating agencies are paid by the issuers. The government that wants a good rating is the one paying for the rating. So there's pressure to be generous, to overlook problems, to delay downgrades. And that pressure corrupts the entire system. Take Greece. In 2009, Greece was rated A- by most agencies. Solid investment grade. Then, in a matter of months, it collapsed. The rating agencies slashed it to junk. Overnight, Greek bonds became toxic. But the debt problems didn't appear overnight. They'd been building for years. The agencies just ignored them. Why? Because downgrading Greece would have triggered a crisis. It would have hurt European banks. It would have angered the EU. So the agencies waited. They hoped the problem would go away. It didn't. And when the downgrade finally came, it was too late. Investors were blindsided. Insurers who relied on those ratings got crushed. And it's happening again. Right now, there are countries with investment-grade ratings that are on the brink. Their debt is unsustainable. Their deficits are exploding. Their currencies are collapsing. But the rating agencies are slow-walking the downgrades. Why? Same reasons. Political pressure. Conflicts of interest. Fear of triggering a panic. So the ratings are lies. Comfortable lies, but lies nonetheless. And insurers know it. They've stopped trusting the agencies. They're doing their own research. They're building their own models. But that's expensive. It's slow. And it's risky, because they don't have the resources or data that the agencies have. So they're stuck. They can't trust the official ratings. But they can't afford to ignore them. So they're trapped in a system that's fundamentally dishonest. And the only rational response is to stop playing. To stop insuring sovereign debt altogether. Because here's the brutal truth. All 6 of these triggers are interconnected. Hidden liabilities make FX mismatches worse. Derivative exposures amplify political interference. SOE debt corrupts rating models. And rating model failures hide all the other risks. It's not 6 separate problems. It's one systemic failure. And it's making sovereign debt uninsurable. Think about what that means. For decades, the global financial system has rested on the assumption that government bonds are safe. Banks hold them as reserves. Pension funds use them for stable income. Central banks buy them to control interest rates. Insurance companies rely on them to back policies. The entire architecture of modern finance is built on the idea that sovereign debt is the ultimate safe asset. But that assumption is dying. And when it dies, everything built on it collapses. We're already seeing the early stages. Sovereign debt defaults have tripled in the last decade. Countries that used to restructure quietly are now defaulting loudly. And the defaults are getting bigger. In 2020, Lebanon defaulted on $30 billion. In 2022, Sri Lanka defaulted on $50 billion. These aren't small economies. These are mid-sized nations with deep ties to the global financial system. And every default makes the next one easier. Because investors lose confidence. Insurers pull back. And the market for sovereign debt starts to fracture. But the real danger isn't the defaults we've seen. It's the defaults we haven't. Because there are countries right now that are in worse shape than Lebanon or Sri Lanka, but haven't defaulted yet. They're being propped up by emergency loans from the IMF, or by central banks printing money, or by sheer denial. But those supports are temporary. The debt is still growing. The liabilities are still hidden. The FX mismatches are still there. The derivatives are still ticking. And sooner or later, the props give way. And when they do, the defaults won't come one at a time. They'll come in clusters. Because all these countries are connected. They borrow from the same banks. They're insured by the same companies. They trade with each other. So when one goes down, it drags others with it. And the insurance market, already fragile, shatters completely. What happens then? Chaos. Banks that hold sovereign bonds see their assets evaporate. Insurance companies that sold CDS contracts face payouts they can't meet. Pension funds that relied on government bonds lose their income. And governments, desperate to stop the bleeding, impose emergency measures. Capital controls. Debt moratoriums. Forced restructurings. Maybe even outright confiscations. Because when the system breaks, the rules go out the window. And the people who suffer most aren't the politicians or the bankers. It's ordinary people. Retirees who lose their pensions. Savers who lose their deposits. Workers who lose their jobs when the economy seizes up. This isn't some distant, theoretical risk. This is the next crisis. And it's being driven by forces that are already in motion. The debt is already unsustainable. The liabilities are already hidden. The derivatives are already tangled. The political interference is already happening. The SOE debts are already ballooning. The rating models are already compromised. All 6 triggers are active. All 6 are accelerating. And the insurance market is running out of time to adapt. So here's the question you need to ask yourself. If sovereign debt is becoming uninsurable, what happens to everything else that depends on it? Your pension, your savings, your country's currency. Because when the foundation cracks, the whole building comes down. And we're standing on a foundation that's riddled with cracks. The scariest part? Most people don't know this is happening. They see headlines about government debt, and they tune out. It sounds boring, technical, distant. But it's not. It's the most important financial story of our time. Because when sovereign debt breaks, everything breaks. And it's breaking right now. Slowly. Silently. But inevitably. So what can you do? First, understand the risk. Don't trust official debt numbers. Don't assume governments will always pay. Don't believe that rating agencies have it under control. They don't. Second, diversify. Don't put all your wealth in assets that depend on government stability, because that stability is an illusion. Third, stay informed. Watch the countries that are struggling. Watch the insurance markets. Watch the credit spreads. Because the warnings are there, if you know where to look. And fourth, prepare for a world where government bonds aren't safe anymore, where capital controls are common, where defaults are frequent, because that world is coming. And the people who see it early will survive. The people who don't won't. We're living through the end of an era. The era of safe sovereign debt. The era of unlimited government borrowing. The era of cheap money and hidden risks. And the next era. It's going to be brutal. More defaults. More crises. More emergency measures. More pain for ordinary people. But also more truth. Because the lies can't hold much longer. The hidden liabilities will come to light. The derivative exposures will be revealed. The political games will be exposed. And the world will be forced to confront a reality it's been avoiding for decades. Governments are not immortal. They can fail. They can break. And when they do, the consequences are catastrophic. That's the message of this video. Sovereign debt is becoming uninsurable because the risk has become incalculable. 6 silent triggers have converged to break the models, shatter the assumptions, and expose the lies. And the insurance market, which is supposed to protect against disaster, is quietly giving up. Because you can't insure against systemic collapse. You can only try to survive it. So here's my final question for you. If the safest investment in the world is no longer safe, what are you going to do about it? Are you going to keep pretending everything's fine? Or are you going to face reality and prepare? If you made it this far, you're already ahead of 99% of people. You understand what's coming. Now the question is whether you'll act on it. Drop a comment and tell me, which of these 6 triggers scares you the most? Or is there a 7th one I missed? Let's keep this conversation going. Because the more people who understand this, the better our chances of navigating what's ahead. And if you want to stay informed, hit that subscribe button. Because we're going to keep digging into the forces reshaping the global economy. The stories the mainstream won't touch. The data the politicians want buried. And the truths that could change your life. This is just the beginning. There's so much more to uncover. So stay with us. Stay sharp. And stay prepared. I'll see you in the next video. Until then, watch the cracks. Because they're spreading faster than anyone wants to admit.